Hello everyone, welcome to weekly lecture videos. This week our topic is financial statements, taxes and cash flows, and working with financial statements. And we are covering two chapters this week, chapter 2 and chapter 3. First, chapter 2. Chapter 2 has 4 learning objectives. So as usual, I will be uploading one video explaining each of these learning topics. So in this video, I'm going to focus on the difference between accounting or book value and market value. So let's start with balance sheet. I think most of you have an idea about what a balance sheet is. Balance sheet is also known as the statement of financial position. This is a snapshot of the financial position of a firm at a particular time. So it is a convenient means of organizing and summarizing what a firm owns, that means its assets, and what the firm owes, that means its liabilities, and the difference between these two. Okay. In the left-hand side, balance sheet has assets, and in the right-hand side, it will have liabilities and owner's equity. Asset side can be classified as current or non-current. Okay. A non-current asset is the one that has relatively long life. And these non-current assets can be tangible as well as intangibles. Okay. Tangible asset, for example, building, machineries, equipment. Intangibles like trademark or patent. A current asset, on the other hand, has a life less than 1 year. Okay, so which means that they are expected to be converted into cash within 12 months. For example, inventory. So as I already mentioned, that the right-hand side of the balance sheet represents liabilities and equity. A firm's liabilities are listed first, and the below of that is equity, and liabilities are also current and non-current. The current liabilities, like current assets, are expected to be repaid in 1 year. For example, accounts payable, and the non-current liabilities are those have a longer maturity or longer payoff. For example, 5 years or so. Okay. Finally, by definition, the difference between the total value of assets and the total value of liabilities is shareholders' equity, or also called stockholders' equity. The feature of the financial statements, feature of the position of financial statement is intended to reflect that by this equation. So you can see assets equals to liabilities plus equity, which means that assets minus liabilities should be equal to equity. Okay, so this is the statement of financial position, or this equation is also called balance sheet identity or equation, and it always holds because shareholders' equity is defined as the difference between assets and liabilities. So this is a typical balance sheet will look like. So you can see in the left-hand side, there are assets, current asset, non-current asset. In the right-hand side, there will be current liabilities, non-current liabilities, and last of all, shareholders' equity. Just a few additional terms related to balance sheet. First of all is net working capital. So as we can see in this balance sheet, we have current asset in the left-hand side and current liabilities in the right-hand side. The difference between current asset and current liabilities is called net working capital. Okay, this net working capital could be positive or negative at a given point in time. So if net working capital is positive, which means current assets exceed current liabilities, it means that the cash that will become available over the next 12 months exceed the cash that must be paid over the same period of time. So which means that a positive net working capital indicates a healthy financial position of a company. Liquidity refers to the speed and ease with which an asset can be converted into cash. For example, gold is a relatively liquid asset, whereas a custom manufacturing facility is not. Liquidity has two dimensions: ease of conversion versus loss of value. Any asset can be converted to cash quickly if we cut the price enough. A highly liquid asset is therefore the one that can be quickly sold without significant loss of value. Okay, an illiquid asset is the one that can be converted quickly. An illiquid asset is the one that cannot be converted quickly without a substantial price reduction. Okay, and last of all, debt versus equity. To the extent that a firm borrows money, it usually gives first claim to the firm's cash flow to its creditors. Okay, equity holders are entitled only to the residual value, the portion left after creditors are paid. The value of this residual portion is the shareholders' equity. Okay, shareholders' equity in the firm, which is the value of the assets minus value of the liabilities. This is true in an accounting sense because shareholders' equity is defined as the residual portion. And more importantly, it is true in an economic sense. If the firm sells its assets and pays its debt, whatever cash left belongs to the shareholders. Okay, the use of debt in a firm's capital structure is called financial leverage, and the more debt a firm has, the more financially levered a firm is. We will learn this point more detail later. In market value versus book value, the true value of any asset is its market value, which is simply the amount of cash we would get if we sold it. In contrast, the values shown on the statement of financial position for the firm's assets are book values. Generally are not what the assets are actually worth. Okay, under the Australian Accounting Standards, AAS, audited financial statements in Australia generally show assets at historical cost or at their book values. In other words, assets are carried on the books at what the firm paid for them, no matter how long ago they were purchased or how much they are worth today. Okay, for current assets, market value and book value might be somewhat similar since current assets are bought and converted into cash over a relatively short span in time. In other circumstances, they might differ quite a bit. Moreover, for non-current asset, it would be purely a coincidence if the actual market value of an asset were equal to its book value. Now, managers and investors will frequently be interested in knowing the market value of the firm. The information is not on the statement of financial position. The fact that many balance sheets are listed at cost means there is no necessary connection between the total book value of firm assets and the market value of the firm. And indeed, many of most valuable assets that a firm might have, good management, a good reputation, talented employees, do not appear on the financial statements. One of the issues in using book value of assets which does not reflect the market value is that the shareholders' equity reported on the statement of financial position will not reflect its market value, thus the market value of the firm. For financial managers, the accounting value of equity is not an especially important concern. It is the market value that matters. Henceforth, whenever we speak of the value of asset or the value of firm, we will normally mean its market value. Okay. So for example, when we say the goal of financial manager is to increase the value of the firm to its owner, we mean that market value of the firm's shares. Okay. So in decision-making purpose, market value is more important. And the market value and book value are different because book value are the historical cost of the asset, while market value of the current value of the assets if we sell them in the market. Okay, so this is the end of our discussion related to the learning objective 1. We will discuss the learning objective 2 in the next video. Thank you very much.